Welcome everyone. Welcome to a brand new show where we'll be talking to you about the market updates, and this is brought to you in collaboration with Small Case along with the Zerodha team. So the format of the show is very simple. Throughout the week there are multiple things that happen in the markets, and as a retail individual investor, it can actually get quite overwhelming. So here we enter into a free flowing conversation to try and break down a few updates that went through the week. And joining me today from the small case team are Naveen and Shyam. And this is Saket from the Zerodha team. So welcome to the show, guys.
Hey, thanks, Saket. Hey, Shyam, how are you doing?
Hey Naveen, hey Saket, thank you so much. I think it's gonna be fun.
Great. So, guys, why don't you give a quick introduction about what you guys are doing at Windmill Capital and how does that sort of fit into, how a retail investor can, really see into tapping what is relevant for them and what is not.
Yeah, sure. So I think at Windmill Capital, the intent for us has always been to keep things very simple and calm. We are a very small team of six folks, and we try and maintain and create different portfolios. On the small case platform itself, we have more than 50 small cases. Uh, that is like spread across different strategies on the quantitative side, on thematic side. Then we have sectoral small cases as well. So I think to keep it short and simple, I think we try to explore market opportunities as and when they come, and try to like educate our investors about different market concepts that have been running around.
Great. So, guys, let's start with what I think the main talking point which has been going around throughout the week has been how, let's say, the World Bank has cut GDP forecasts for India, and it's not just the World Bank. In the past month or so, we've seen multiple agencies, right from an S&P to a Fitch to even Moody's, put some sort of let's say reduction ranging anywhere from 20 to 100 bips in the GDP growth forecast for FY23. So Naveen, would love to hear your thoughts.
Thanks, Saket. So I think a couple of things that World Bank is talking about is high commodity prices, supply disruptions, and the sort of food insecurity that has been going on because contributing to inflation. And the World Bank's rationale sort of has been that all of these things are going to result in inflation peaking. That is, it is expected to sort of go up from here, and then it sort of go to plateau from that level sometime in mid 2022, and then this is going to cause monetary policies to be sort of tightened, and that is going to result in a hit on the growth numbers. So essentially, they are highlighting a risk of stagflation, which is a combination of where there is very high inflation, that is month on month or quarter on quarter increase in prices of goods, plus sluggish or a non-existing growth. So the industry term is stagflation. Stagflation. That is what World Bank is highlighting at. Most other, multinational or international firms have also been talking about this, and RBI is also sort of doing the same thing. From an individual investor perspective, what is pertinent is the expectation of inflation sort of going to stay at an elevated level. Everybody is going to get affected regardless of whether you are a participant in the market or not. Prices rise, and it's difficult for everybody. So that is a pertinent factor. Whether it is 1.2% drop cut that World Bank is projecting, or the 80 bips, that is the 0.8% drop that RBI is projecting, that I don't think will make too much of a change for any one of us. So if you are, whether you are invested in the market or not, inflation worries are going to persist, and if you are invested in the market, what you should sort of be wary about is continued inflation plus any further tightening of screws by Reserve Bank of India, where they are going to increase interest rates.
Right. Anything you want to add on this, Shyam?
Yeah, I think for me particularly, I sort of take this with a pinch of salt. And also, just very recently, just before this call, I was just going through an article from the Deputy Governor of RBI, wherein he's saying that the quarterly updates of a few banks came in, like HDFC Bank and Bajaj Finance reported their Q2 updates, and they've shown massive double-digit credit offtake. This just reminds me one another point that I was looking at. So basically, on this backdrop, CRISIL just recently put out a note saying that India's credit quality, like India Inc.'s credit quality, has risen manifold over the last couple of years. So basically, for every one company that they're downgrading, they're upgrading almost six companies. That is a massive positive for anyone who's sort of looking at Indian markets, right? And that is one of the reasons why FII money is also sort of coming back. Not in the biggest of ways, but I still reckon that FIIs are showing a lot of faith in the Indian markets.
Yeah, so if I were to sort of sum up what we've discussed, I think the writing is on the wall that yes, prices of commodities have been going up, and okay, in the shorter term, it's a cause for worry. I mean, this is something which keeps happening over time. I mean, for the last 2 or 3 years, we've seen some massive commodity price swings, whether it's metals or sugar or coffee or for that matter even paper. Both of you did mention about a point that yes, that the credit offtake has been something which has been quite exceptional, and I mean there also. I mean I just feel just to sort of. I mean, my thought there was, I mean, for the longest time, if you see both the benchmark indices have their maximum weightage towards banking, and in the last 2 3 years, while we saw there were stops and starts in economic activity, credit growth was sort of always a little volatile. But right now, we do see there's a clear sort of path for some growth expectations to really kick in, something that people have been waiting to see for maybe the last 2 or 3 years. And that's something which can really play out well, not just for the sector as a whole, but also maybe uplift the index because it contributes the maximum amount of weight. So that's something that even I'm quite excited about, to look at how this credit growth comes in and some of the numbers that these banks are reporting, whether it's on the private side or even on the public side, is something which is worthwhile for investors to look into and not sort of get quite fearful of what gloom and doom some of these global agencies have to talk about. The other interesting thing that happened, guys, was this week we saw a lot of auto sales numbers coming in. So, any thoughts around this space in case if you guys have been tracking it and how this whole outlook looks? Sham, do you have any thoughts?
Auto sector is one of the closest sectors that we track internally. Just for the uninitiated, so the Nifty Auto Index has companies that are obviously four-wheeler manufacturers like Tata Motors, Maruti Suzuki. Then there are two-wheeler manufacturers like Bajaj Auto, Hero MotoCorp, and then there is another sort of companies called auto OEMs, which make different parts of, say, a tire company or a battery company, right? So basically, this is what the Nifty Auto Index consists of. Now, as far as the auto sales number is concerned, Saket, I think the number was very good from a quarter on quarter perspective. Even from a year on year perspective, it is pretty good. The sales across different categories, passenger vehicles, commercial vehicles, tractor space, has all been very resilient. Companies like M&M, Tata Motors, they have shown good sort of growth in the SUV segments, given how M&M is particularly very aggressive on the SUV space. But one interesting thing you'd note is that the auto sales data was very nice, but then Nifty Auto Index fell by 2% that very day when the data came out. And I think the curious case behind this is that, firstly, Auto Index, if you see, it's the only index that has run up a lot as compared to all the other sectoral peers. So right from like June onwards, when markets began their recovery post the Russia-Ukraine conflict, Nifty Auto has one of the sharpest recoveries. But then again, it has sort of flattened out. So I think one of the things that markets are factoring in is the pre-COVID era. Before COVID hit us, uh, like the sales of like passenger vehicles, etc., were hovering around like the 4 lakh units mark. If you see 2022's data, it is still around 4 lakh units, in fact, lesser than what the entire sector achieved in 2019. So I think that is one of the reason why the excitement sort of has died down. But it's a double-edged sword because on the other hand, interest rates are also rising up, right? And finance costs for auto companies or like people who are buying four-wheelers or two-wheelers are going up, and that is also sort of sombering the mood. What do you think, Naveen?
Have some numbers here in front of me. Probably the highest point that we reached as far as auto sales. When I'm talking about auto sales, I'm talking about passenger cars, I'm talking about trucks and buses, two wheelers, three wheelers, everything. So all of those put together, I think we were somewhere at around 2 crore, 2.6 crore point in 2018-19 period. That is April 2018 till March 2019. And currently, that is during the most recent financial year, which was April 21 to March 2022, we are at 1.7 crore. So that is a massive drop. And if you look at a subsector level, you can see that pretty much everybody has done poorly, whether it is passenger cars, whether it is commercial vehicles, which is your trucks and buses, three wheelers, two wheelers, everybody has been doing pretty badly. So that is definitely a factor. And that is sort of reflected in the performance of the index also. The highest point probably ever the index hit was back in December 2017 when the auto sales were really good. After that, there's been a continuous downtrend till March 2020 when the entire market melted. There's been a subsequent pickup, but that pickup obviously was attempting to get back to the previous high level, and it is only since probably sometime in June 2022 when the entire market sort of took off that we have started seeing auto index also sort of gaining some traction. But then, like Shyam said, one factor that is sort of leading to flattishness amongst for the index is some worries around whether they will be able to replicate their performance of previous year. Couple of things that are contributing to that issue is the issue of interest costs. Now what happens is most of these auto sales are based on loans taken by people from banks, and that is how the finance comes through. So the higher your interest rate, people decide to put off that consumption. They don't go ahead and buy their two wheelers or three wheelers or trucks and buses or cars, right? So any interest increase by RBI has a negative impact. Another factor that is sort of affecting the auto industry is all the price increases that I've had to take because of inflation. Now commodity price increases, like steel price increases, aluminum price increases, you obviously have to pass it on to the end consumer in order to protect your sort of performance. That is another factor that contributes. But so far, at least as far as August numbers are concerned, I think that's like an exceptionally good set of numbers, like Sham said.
So, on this thought, gentlemen, like any thoughts on whether you guys are seeing any disruption with the whole EV space coming in, right? So, we are seeing quite a few players selling two wheelers. I mean, in four wheelers, obviously, there are one or two players that are trying to do something or the other. So, is that something which is sort of disrupting or making any changes to the overall numbers? Any thoughts there?
Yeah, so I think with the case of EVs, it's a very peculiar case because on one hand, auto companies are being very bullish on the fact that the EV ecosystem will pick up, especially in India. But the problem is on the infrastructure side, right? So few months back in the budget itself, I think our finance minister mentioned about battery swapping technology, and where there have been various mentioning of how this battery swapping thing has been a complete hit in the US. But the problem is that there hasn't been any sort of implementation guidelines as of now. And until we get the infrastructure right for EVs, it's going to be pretty difficult for it to take off. And there is no uncertainty when you take your car out. You don't have that uncertainty that will I get back home with the required amount of charge. I think that is one of the major bottlenecks as far as the entire ecosystem is concerned. But nonetheless, I think there has been a great amount of progress from both the supplier side and from the buyer side, wherein people are accepting EVs with like open arms. And you are seeing a lot of EVs running around here and there. In my society, I've been seeing so many people buying EVs. So I think that's a very positive sign for the sector.
Finally, the government seems to be getting its act together. Well, obviously, COVID was definitely a huge disruption in terms of what the government could afford to spend. But they seem to be getting back on track. In 21-22 period, the provisional numbers were around 800 crore. So that was the highest. And subsequently, that is for the current year, close to 3,000 crore rupees has been allocated towards Fame India. Now, where does all of this money go? They're going to give subsidies if you buy electric two-wheelers. They are giving you tax cuts if you go ahead and buy electric two-wheelers. There is scrapping of registration fees if you buy electric two-wheelers. They've also implemented the scrappage policy. So finally, we seem to be getting back on track in terms of actually taking this electric mobility plan quite seriously, sort of to shamelessly plug in whatever we have been doing on the electric vehicle front. Windmill Capital was one of the first people who put out an electric mobility small case. So we've done a fair amount of research around this. Initial days when we were talking about electric mobility with companies and we used to read through their presentations and the annual reports, there was very few data points that was available. Finally, over the last couple of years, we've started to see that things have started changing. One point in one case in point is Mahindra and Mahindra, one of the biggest SUV companies in India. So they have laid out $1 billion roadmap plan over the next couple of years to spend on electric two-wheelers. So whatever Scorpios and XUVs and stuff like that you're seeing today, which is your traditional petrol and diesel vehicles, everything is going to come in electric mobility variant also. So a lot of different things, exciting things happening on the electric mobility front. So overall, I think we are quite bullish about this sector.
Just to sort of sum up and actually to sort of give a contrarian view here. Personally, I'm a proud EV owner. So I upgraded from an ICE vehicle to an EV almost 2 months back. And it was a long time waiting for the car to come home, right? So yes, I actually waited 2 years to take that decision. And finally, when I saw that, okay, there's a OEM which is setting up a charging station at home and okay, you have to use the car within city travel. The range anxiety sort of goes out. And I think, Naveen, you mentioned a lot of these data points around FAME and, how there are these some subsidies right from the center to the state level. In fact, there are even tax incentives to own a vehicle. I think more than that, at the end of the day, consumers only care about one thing, and which is a great product and value for money. Guys, so over to the final section of today's episode. I think the other news that was doing the rounds was the fact that the OPEC has now decided that they are going to cut oil production. And there is always volatility around the global energy space. So there was also some other developments. So any thoughts there? And maybe Shyam, you can start by telling viewers what exactly is OPEC and how does this change our lives or how does this affect us? So any thoughts there?
So basically, OPEC plus for the for people who don't know, OPEC Plus is basically an organization of the petroleum exporting countries. And it's an amalgamation of different countries like Bahrain, Malaysia, Mexico. And they in totality decide the entire supply of crude oil in and across the world. So you can almost consider this as a cartel, right? Wherein they're determining the supply. And obviously it's a basic economy. Like when supply is up, prices will go down, and when supply is down, prices will go up. So like that's the thing that OPEC Plus usually does. How is it going to affect you and me, Saket, or somebody else who's running a shop or somebody who's owning a vehicle? So the crude oil prices directly have an impact on diesel and petrol prices in India, right? So just to give some context, India imports nearly 80% of its crude oil requirements from outside, like countries in like North America, US, countries in like from Russia, Ukraine, etc. So India is very dependent when it comes to oil imports. And the problem is that these prices will only going to impact India's balance sheet more because we have to pay more dollars to get the required amount of oil. Now, a very interesting data point that I would like to share with all our viewers. When we started this year, our dependence on Russian oil was only 1.3%. And we all know that people are boycotting Russia's trade, right? People don't want to trade with Russia. On the other hand, we have been pretty smart. We have kept the emotions out of the picture. And that 1.3% has gone up to almost 15%. So India used to import 1% from Russia back in January. Now it imports roughly 15% from Russia because of price considerations or price concessions that Russia is giving to us. So that is, I think, one of the most smart things that the Indian government has done of late, especially on this energy front. Having said that, since we have so much of dependence from outside, like the petrol and diesel prices can go up yet again, and that is going to be a major dampener to our economic progress. Similarly, if you see, the problem is also there in the domestic space. So domestic gas prices have also risen nearly 40% over the course of the last 2 months. Now, how does this impact you and me or people who are watching this episode? If you own a CNG vehicle, let's say, the CNG cost will go up, right? So it's just like petrol and diesel prices going up. CNG prices will also go up. So maybe there would be a rise in the LPG cylinders that we use in our households, or the normal CNG vehicles will also face the brunt of it because of the overall natural prices going up. So I think we are in a very in a situation where it's like a double whammy for us. The oil prices are also rising, while at the same time energy prices are also rising, and we have to understand this, that energy has become one of the most indispensable things in today's world. Like if you see in India or outside as well, energy consumption per capita has been increasing. Like if somebody has to plot a chart, I'm pretty sure it will be like a 45-degree chart wherein it's just been going up. So I think the way world economy or the world politics is going on, this OPEC plus thing will continue to negatively surprise us, which is not good for anyone, be it an investor or be it somebody who trades the market. But having said that, there might be some respite because of the thing that I just mentioned earlier, that we have increased our dependence on Russia as far as oil imports are concerned. And that is one of the smart ways we are trying to sort of negate this entire energy fiasco that is going on. So I think that's my take as far as this space is concerned.
I think one another factor around Russia that sort of makes sense for India is Russia has made a concession and said you can go ahead and pay for whatever you're buying in rupees, and that is a major factor. That is a major contributor to increasing our buying to 15%. So what it essentially means is, for India, US dollar or the foreign exchange reserves that we have is very expensive, whereas the Indian government can always print more money in rupees and pay off for whatever we need. So by allowing us to hold on to our US dollars and by taking our rupees, what Russia is doing is it is making things easier for us, right? That is one another factor which is sort of like allowing us to increase our dependence on Russia, and probably it makes sense for them also that they have a steady trading partner, a very large economy that is sort of like in times of their need, which is not too worried about US sanctions, and which is able to shrug the US sanctions and is increasing its oil dependency on Russia.
Yeah, so I think to sort of sum this up, I mean, yes, there is something which we would not want in a world of free markets, but yes, there are still players who still sort of control, let's say, X percentage of supply, or a majority of supply of a certain commodity, something which is very essential. Almost India sort of imports almost 80% of its energy requirement from outside. So yes, what the OPEC does here and there does have some implications. Obviously, investing implications come later, but it has economic implications in how things are, right? So even if we don't use a car, let's say the product that's coming to our house, it might get expensive because the logistic cost is going up, because the fuel cost is going up. And yes, this whole statistic that Shyam, you mentioned, this one going to 15, and as you mentioned, Naveen, the settlement of that happening in INR is something which is quite worthwhile for anyone who's tracking the global sort of space. So thanks a lot, gentlemen, for tuning in, and we'll hopefully see you guys again with a brand new episode. And until then, do let us know what do you think about this episode. If there's one takeaway that you would like to take, and if there are any questions for either Shyam, Naveen, or me, we'll be happy to answer them. Just put it down in the comment section.